Passive income may seem like it's out of reach for most people, but it's not. The truth is, you just need the right type of portfolio. I was stuck earning only 1 to 3% in passive income from my portfolio, and at the end of 2024, I shifted my approach by adopting alternative investment strategies. These strategies are used by the top 1% of all investors. I built a portfolio instead that paid me 8 to 10% in passive income, and in this video, I'll show you what I did, why it worked, and the first steps that you can take to gain access to passive income alternative investments. If you're new to the channel, I'm Santiago. I'm a professional investment analyst, and I help high-earning professionals learn alternative investments. To make sense of this shift, you need to see why traditional investments fell short in the first place. I had first built my portfolio with mostly ETFs and dividend stocks. The growth looked fine on paper, but the actual income component from the portfolio produced about a 3% yield. That means a $1 million account throws off about $30,000 per year, and that's before taxes. And most of the time, the yields aren't even as high as 3%. Stocks have been yielding a very modest cash flow for years now, and if you look back over the past decade, S&P dividend yields hovered anywhere between 1 to 3% consistently. There was a disconnect in my portfolio. My account balance would climb in value every year, but the income part, the actual cash I could pull and spend on a day-to-day basis, was barely anything. It felt like I was filling up a water tank and I was not allowed to open it. The paper gains were stacking up in my portfolio, but the flow of money into my pocket stayed very weak. Growth assets can make you wealthier on paper, and those are great. But if your goal is to replace and supplement your living expenses, you need consistent income you can actually use. Dividend stocks and bonds just don't give you that at a meaningful scale when you're first starting out building your account. That pushed me further into alternative investment strategies. When I became a professional investment analyst, I began to study how the wealthiest investors structured their portfolios, and I realized they weren't just investing in a mix of 60-40 stocks and bonds like the traditional investment portfolio. Instead, a share of their allocation went into private credit, specifically a segment we call direct lending. I'll explain what direct lending is. This is where capital flows not through public markets like stocks and bonds, but directly into loans negotiated with private companies. Direct lending strategies built the mechanics that help explain why the yields could be higher and build passive income in a portfolio. These loans use what's called a floating rate, which means that the income adjusts upwards when interest rates rise. Direct loans are also senior secured, which places them near the front of the repayment line if anything were to go bad with the loans. And most include a lot of protective terms known as covenants that require borrowers to keep certain financial discipline to protect the investors. Together, all those features create a structure that's aimed at producing steady income for investors. As a matter of fact, over the last decade, direct lending strategies delivered a total return above 8% in more than 70% of the quarters analyzed. Even during difficult periods like the COVID-19 downturn, when we've seen a lot of companies take away dividends and bond yields went near to zero, private credit actually remained consistent. On top of that, the asset class has shown relatively low correlation with stocks and bonds. This means that if you add it to your portfolio, you can smooth the ride when you have public market swings. For me, private credit shifted the way I thought about passive income. Keep in mind, though, that accessing it as an individual investor is not always an exactly straightforward process. So the theory of using private credit made sense, but the reality was I didn't have millions of dollars to deploy like the top 1% of investors. So now I had to fix this challenge and learn how to gain access to private credit as an individual retail investor. So being an analyst, as I began to explore and learn more and more about alternative investments, I crossed into beginning to use alternative investments. And this meant finding ways to actually participate in these private credit strategies without the institutional barriers. And we'll talk about some of those institutional barriers. Traditionally, access was limited to very high minimum investments, long lockup periods of your money, and it required heavy due diligence. But in recent years, there's been newer structures, semi-liquid funds, and also publicly traded BDCs, which have lowered some of those hurdles and opened up paths that weren't available to individual investors just even 10 years ago. One option that I decided to use was business development companies. This is also known as BDCs. These were created to provide financing to small and medium-sized businesses, and they distribute a large share of their income back to the investors. Because many BDCs are publicly traded, I could purchase shares on a regular brokerage account, much like I would an individual stock. And that lowered the minimum commitment dramatically, which made it possible for me to begin testing private credit strategies on a much smaller scale. Another path I learned about and took a look into was semi-liquid private credit funds. Unlike traditional private credit funds that might lock up my money for 5 to 10 years, these allow redemptions in set intervals. Usually this is set quarterly or annually. Semi-liquid funds are not as flexible as the publicly traded BDCs, but they offer a middle ground between illiquidity and private markets that lock your capital up for 5 to 10 years. So that balance was attractive because I wanted the higher yields to build passive income, but I still needed some form of liquidity with my money so that I can access it in case of emergency. So now that I crossed that path of gaining access, I had the challenge of what can I actually do in my portfolio and how can I allocate to build passive income in a responsible way. Building the new income in my portfolio meant turning the theory that I had learned about alternative investments and private credit into an actual structure that could produce the reliable cash flow that I was looking for. Knowing about private credit was useful, but the hard part was deciding how much to put it into practice in my portfolio without stacking on too much risk in one place. I couldn't just simply load up on the highest yielding passive income vehicles and just call it a day. The construction had to be deliberate that allowed me to build for the future, but get passive income for today as well. One of the first lessons that I learned is that manager selection when you're looking at private credit shapes outcome much more than in the public markets. Research show that meaningful dispersion in private credit returns, which means that the difference between a disciplined manager and an aggressive one can be enormous. You can get really high returns or you can walk out with nothing. So I knew I needed to begin diversifying across multiple private credit managers, and I didn't want to bet my allocation on a single strategy or a single firm because that just wouldn't be good. When I started screening managers, I looked for 5 things. I looked for an emphasis on senior secured first lien loans, floating rate debt structures, strong covenant packages, proven focus on solid deals, and disciplined loan to value ratios. Each of these helps limit the downside risk. There are risks though, and I weighed them with the trade-off of creating the passive income. Direct lending can improve portfolio income, but trade-offs also include illiquidity, opaque valuations a lot of times. You still have your borrower credit risk and the use of leverage. So I only committed capital that I could afford to possibly lose over that period. And illiquidity is a real thing. You don't want to underestimate what illiquidity meant. So you needed to have a good manager with a good track record because they could gate your liquidity at any time. In terms of actually building the mix, I never actually abandoned the use of stocks and equities, but instead I added an alternative allocation. These positions in private credit made a big difference. And historically, research shows that including private credit in a traditional portfolio, a 60-40, for example, could balance the performance and also lower the overall risk. And that gave me a portfolio that did 2 things. I had growth on one side and passive income on another side. So this method showed me that I could build passive income with meaningful levels in my portfolio, borrowing from the playbook that already existed from the most sophisticated investors that used alternative investments. So to take that jump from low passive income investments like the S&P dividend yield and bonds in certain cases to something that was closer to an 8 to 10% passive income came from using private credit alternative investment strategies. Direct lending alone made up roughly $848 billion of private credit AUM at the end of 2024, and newly created private credit structures gave me a way to access these investments. But in the end, you have to do your homework. Keep in mind that these strategies carry risk and may involve the illiquidity and higher fees. Always verify the suitability of the investment before investing. And then if you need to, seek professional help. This is never investment advice. I share my experiences to open up different ideas for investing. Of course, I'm a professional investment analyst, so I do this for a living every day, which may not be your personal circumstance. So always keep that in mind. So if you found this information useful, I want you to go ahead, like this video, subscribe to the channel. And if you're interested in learning all about different alternative investments, go ahead and click the link in the description to sign up for my email list. So now that you understand how you can build passive income in your portfolio using private credit alternatives, what I want you to do is click the video linked above, where I'll discuss why private equity is spending billions of dollars investing in professional sports teams.